Good morning, ladies and gentlemen. The past week was really in the sign of a breakup of the relationships in bond spreads in Europe, and that has had its effect on all the other markets. As you know, the new Italian government is deemed Eurosceptic and deemed expansionary in fiscal and monetary policies, and that was on Friday added to the political crisis in Spain. So there is a definite whiff of crisis in Europe and a possible future breakup of the euro into two, a northern euro and a southern euro. That, of course, has made bond spreads go absolutely wild. People are fleeing periphery countries and buying core countries simply because they fear that if they have Italian bonds, they might be repaid in lira at some stage, or pesetas, or some other some other currency, which is going to be devalued by 10, 20, 30% against the currency they bought the bonds in, and that is the euro. So we've had something that we haven't seen in a very long time. We've seen a move in in bunds much lower. We've seen it test the weekly Bollinger Band, and probably we will see it over the course of the next week or so go all the way down to at least 0.27, which would be an equality target of this move ABC down. So certainly the Germany, it will not rally in terms of yields anytime soon, certainly not in the next couple of weeks until more news comes out of Italy, as opposed to what Italy has done, and that is basically move straight through the top of the Bollinger Band. Now it's interesting to note that the ECB has done very little so far to attenuate this move, and that this is probably a political play on behalf of the ECB. They want to put the new Italian government on notice that they might not be a lot of help, but the Italian government probably doesn't care. That is why this move has been so strong, and it's unlikely to be unwound completely in the weeks ahead until a lot more clarity comes out of Rome. And therefore the spread between bunds and BTPs will continue to be under pressure, and we will see a continuation of the risk-off moves we have seen last week. If we look at the bobble, which to us is going to be the real trade at some stage, this is actually offering us and will continue to offer wonderful opportunities. We would love to see the bobble come and test these levels around minus 39 basis points, 38, 39 basis points, where it spent a lot of time in 2017 and could not break through. That would be a wonderful level to do some options, looking for a lot of upside in the bubble. So we are we welcome this move, because the more people flee into negative yielding assets, the more we will have wonderful opportunity from these ridiculous negative levels to see positive levels again, and the move will be that much stronger. Therefore, anything between minus 40 and minus 37 is the level that we are looking for to put on some sizable option plays, which we will definitely tweet. If we put on a monthly chart for the Bund, we can see where we are. We are right at the middle Bollinger Band. That means that we could easily have a break all the way down to 13 to 17 basis points over the course of the next couple of months, if the crisis persists and gets much worse. And if we do the same for the bobble, we can see how well really it never stays below the lower Bollinger Band. that could, in theory, go all the way to the lows around -60 over the course of the next couple of months. But we think that this area around -40 is going to be very, very difficult and tough to break, and that is where we want to make a stance. But you can see how much room things have on the downside. If we have a look on the Italian chart for the 1 month, we can see we are right on top of it, and therefore things are unlikely to get much worse unless there are some fantastically bearish news out of Italy in the foreseeable future. We don't think that's going to happen. We think it's going to hug this line and probably trade 25, maybe 29, 30, go break, come back, and basically do this kind of a pattern before the monetary and fiscal policies of the well, really basically the fiscal policy of Italy is decided upon. What are the implications of the European situation for other markets? You have seen how we have failed at 322 in the bond. We've come screaming back, and now we're in consolidation phase. We are unlikely to break certainly 297. That is going to be almost an impossible level to break. This is all risk off and flight to safety. A lot of European institutions are buying the states because Germany is so negative and makes very little sense. Plus, we also know that if there is an Italian lira devaluation, i.e. there's a breakup of the euro, certainly the dollar will not be affected in any way. The dollar is there, and the dollar at the moment is in full retracement against the euro. So it does make sense for European institutions to actually buy some long-term US paper, and this is what we're seeing at the moment. It is unlikely that we will retest 322 with any conviction in the weeks ahead. It is more likely to consolidate between 395, let's call it, and basically 320. So that's a 25 basis point range that we could see the 30-year trade for the foreseeable future. What does that entail for the 10-year? Well, the picture here actually is even clearer. We are now in a 270 to 3% range for the foreseeable future, unless some incredible news comes out about inflation, which we certainly don't expect. The Fed is on a tightening cycle. We know that it'll tighten in June, but after that, the odds of 2 further rate hikes in 2018 are almost baked in. 3 is now becoming almost no chance whatsoever, we would say. 2 more maximum, and that gives us an upside of around 3 and a downside of around 270. So a 30 basis points range trade for the 10-year, and therefore with the risk off that's going in Europe, it's more likely to go towards the 270 in the next few days rather than retest the 3. So if we see anywhere near 298, something like that, it's good time to put on some option positions for a couple of months towards the 270 area. That is more likely to happen than breaks towards 311 and 313 above. So this is actually going to be a bit of a both a headwind and a tailwind for US equities. It is going to be a headwind insofar as we have risk off, but it's also going to be a tailwind insofar as the fear of our fear and also Gundlach's fear that the bond market would cause a repricing in equities is going away. And we will see the implications for equities in a second. The interesting thing is that really the European crisis has been so well discounted in foreign exchange that very little is happening of significance. We still have not even tested the 114.84 level. I call it 115. We're still a good percent above it, and the fact that the market is now so oversold indicates to us that 115 is going to hold, and we are really only a percent away from it. Therefore, the dollar now is going to probably stop being a huge headwind for US equities. We have now the situation that it's so deeply discounted that US equities are unlikely to be put off course by a violent move in the dollar, and that is good. We now have two sources of tailwind and one source of headwind in the equity market. If we move on to US equities, we will see that for the second week in a row, we've really been in a 2700, 2740 trading range. Every time it gets to 2740, there is large distribution, there are heavy offers, and 2700 has been bought every time. What is more likely to happen than not? Simply because we have a risk-off phase and people are de-risking in Europe, we are more likely than not to see a break of 2700, basically just to get rid of the bulls. Probably come all the way down towards 2660, where this trend line is, and spike it maybe a couple of times. But from there, we think the move down will be moderated by by what is going to become a tailwind for equities, and that is the dollar is no longer cheap, and therefore people will be willing to transfer currencies from other into other currencies, and therefore the US market will become cheaper. And also, as we looked, the yields are no longer pushing the discounts in the equities north, and therefore we will have significant support of equities at lower levels. Those lower levels we think are not much lower than the 2660 area. It would be lovely to see a break down towards 2660, and then people realize that there is no more downside and up we go. This would be typical summer trading in a 100-point range between 2640 and 2740 for the foreseeable future, as we don't have any outsized forces to push it through either of those very important levels for the time being. In the European markets, the level to look at is 3,422. That's the 0.382 retracement of this whole move up. We will have the 200 period moving average catching it. That to us is the level. We have all these previous areas of congestion. That will be the level that the market should trade at, and certainly 3,464, which is a gap which probably could happen even on Monday, and then this is the level that we're looking for towards the end of the week to buy 3,422. That will be the level that we will be interested in doing some long-term options, simply because we don't think that anything that Italy does is, or even Spain, is going to be remotely negative for European equities. Even if there's expansionary monetary policy, well, that has to be good for equities. It's not good for bonds, and therefore the move that we think is going to prevail into year end after this initial crisis, as we call it, has passed, will be one of Europeans moving out of the fixed income that they have bought now at silly levels and going into equities. It is more likely than not that this is actually going to be the catalyst for an expansionary policy in Europe, as the politicians realize that this German fetish with tight monetary policy or tight fiscal policies and austerity is not good for Europe, and at some stage things will very much change and people will be very happy to transfer their huge holdings in fixed income in Europe into something more productive, which is equities. So we think the big opportunity over the course of the next 6 to 9 months will be buying European equities against selling European fixed income. I wanted also to show you a chart of NQ to show you how the leader in the US is certainly not a bearish chart. This could actually turn out to be a very, very bullish chart. And therefore, when the break of 2700 occurs, if it occurs in SPX, it is not a chance to short. It's a chance to wait for good levels around 27, 50, 60, 70 and get long of ES. Here we have a chart, even if we enlarge it, which to us is screaming bullishness. The market just basically, with all the bad news and all the risk off, just finishes the day quite well every time. It is not bust through 7,000, but all it's done is trade 0.5% below 7,000. While this lasts, and we might go sideways a little bit longer, this will just complete the last piece of the puzzle in this chart, and that is turn the 50-day moving average positive. Until then, we have room to come down below 6,800. Those are going to be wonderful opportunities to buy. Anywhere around 6,800 we will be definite buyers, and after that has happened, most probably we bust straight through all-time highs. NQ is again the leader. It's the leader on all the spreads. It is the one to watch for and the one to have bids in. This is just not bearish. And really NQ has no reason to go down. It has, the only thing that is against it is the dollar. But we're convinced that the dollar will turn at some stage, as we've just discussed. The euro is probably nearly as cheap as it's going to get, even during this crisis. And the bonds have come back and will probably stay back, which will give fuel at some stage for NQ to take out these highs and go probably towards 7,500 towards the end of the summer. And so we come to the biases for next week. As we said, 5s and 10s, we're now looking for a range trade of 3 to 270 in 10-year. And to follow that break if it comes. We do not think this break is going to come. We are now buyers of calls if the in terms of futures, if we get anywhere near to 3, and looking for a range trade 3 to 270. So we'll be doing some ratio call spreads, buying the 3, selling the 270, and that is what we think is going to persist. Bunds and bobbles, it is now impossible to be definitive about levels, simply because we have this crisis, and you never know how many people need to be stopped out of their positions and leave the periphery and move into bunds. While that happens, that is the money flow, and that will continue. It will become obvious technically when that stops. You will have a signal. Let's wait for it. There's no point in anticipating it too much. But when it does happen, it's going to be a very, very, very important signal, which will also signify the top of the move out of European equities and into European fixed income, which basically has been lasting since 2008. that will be very much the top of it, and then we will see a rapid depreciation of bond prices and a rapid appreciation of equity prices on a spread. As we said, SPX, no oxygen above 2740, simply because we are very doubtful that markets can stay in that narrow range for very long. We favor now a break of 2700 and a retest, and a retest down towards 2660-ish, simply to clear everybody out, and then we are ready for the move back up in size. So I will put here that 2660 is a buy. Definite options, 2660, 2740 ratio call spreads is the thing to do. NQ, at no stage do we want to get short of that. As we said, 6800, if we can see it, is a definite buy as far as we are concerned. It should go quite a bit higher from there. VX we will watch when this break of 2700 happens. We don't think the VX is powerful enough at the moment to take it much through 2660. That will be our litmus test, and we will be tweeting definitely our opinions as it happens, if it happens. European equities, it's all been achieved. It hasn't seen any acceleration. It's seeing some weakness now, but again, it's a buy. It's a buy because people will have to get out of the fixed income. They are now in a knee jerk to buy. And the move to us is going to be a move away from austerity in Europe and towards expansion. It's going to be a political decision, and that favors equities over fixed income every time in the long term. Nothing much else is. At the moment, EEM is definitely in a downtrend. We're still waiting for a clear signal to basically signal this for you. XLK is outperforming nicely. EEM is not at the moment because of the dollar, but this to us is definitely a trade of the decade. Thank you very much indeed, and have a lovely Memorial Day holiday, and we'll speak to you on Monday and on Tuesday.